Good morning, everyone. Our subject is financial services, and our question is evaluation of lease from leases and lessors' perspective. Our next point is evaluation of lease from leases means user and lessors means owner perspective. Evaluation of lease. When evaluating a lease, both the leasee, the one using the assets, and the lessor, the one owing the assets, have different perspectives based on their needs and goals. Which means, when looking at a lease, the person using the assets means the leasee, and the person owing the assets means the lessor. See it differently. Each has their own goals and the reasons for leasing. So, their evaluation depends on what benefits them the most. Lease's perspective. The leasing means user evaluates the lease to decide whether it's better to lease the assets or purchase right out. There are some key factors include such as advantages of lease, in which first point is lower upfront cost. No need for a large initial investment. Means leasing means you don't have to pay big amount. It is easier on your budget at the start. Second point is flexibility. Allows access to the latest equipment or technology without long term ownership commitments, which means leasing gives you the freedom to use the latest equipment or technology without being stuck owing it for the long term time. Our third point is tax benefit. Lease payments may be tax deductible as business expenses, which means leasing can save you money on tax because the payment you make might be counted as a business expenses, which can lower your taxable income. Our fourth point is preserves cash flow, free up fund for other business activities, which means leasing helps to keep more money available for other businesses needs because you don't have to spend a lot upfront to buy something. Our next point is disadvantage for the leasing. Higher long-term cost. Total payments over time may exceed the purchase price, which means leasing can end up cost more in the long run because when you add up all the payments, it might be more than the price of the buying of the assets. Our second point is no ownership. The leasee don't own the assets at the end of the lease. In operating leasing, which means when you lease something, you don't own it. And the end of the lease, especially with operating lease, you just return it after the lease is over. Third point is restriction. Used may Usage may be limited by the lease agreement, which means leasing comes with the rules about how you can use the assets. For the example, with a car lease, there might be limits on how many miles you can drive. Fourth point is early termination of penalties. Breaking the lease early can be costly. If you decide to end the lease early, it can cost you extra money because of penalties. The next point is lessor's perspective. The lessor evaluates the lease to determine if leasing out the assets is profitable and safe. There are some key factors include in which first is advantages of lessor, in which first point is steady income. receives regular payments from the leasing, which means the lessor gets regular payment from the person leasing the assets, providing them with steady income. Second point is ownership rights retain ownership on the assets which can be leased again or sold later, which means ownership right means you still own the assets even if you lease it to someone else. This allows you to rent it out again or sell it in the future if you want. Our third point is tax benefit. Can claim depreciation on the assets, which means the lessor can save on taxes by claiming depreciation on the assets, which reduces the value of over time for tax purpose. Our fourth point is expand business. Leasing can attract more customers who cannot afford buy or outright, which means leasing helps businesses reach more customers who might not be able to afford to buy the assets right away, making it easier for them to use it. Next point is disadvantages for the lessor, in which first point is risk of default. The leasing may fail to make the payments, which means the lessor risk not getting paid if the person leasing the assets don't make their payments. Second point is depreciation risk. The asset's value may decrease significantly over the time, which means the assets may lose a lot of its value over time, which is a risk for the lessor. Our third point is maintain cost. This, in some cases, the lessor must bear maintenance expenses, which means sometimes the lessor has to pay for the maintenance and repair of the assets. Our fourth point is assets recovery issues. Res- Reposing the assets can be difficult in the lease defaults, which means if the person leasing the assets stop paying, it can be hard for the lessor to take the assets back. Our next point is decision criteria for the lessor, in which first point is credit worthiness of the leasee. Ensure the leasee can make payments on time, which means the lessors needs to make sure the person leasing the assets is reliable and able to make payments on time. Second point is asset value and market value demand. Evaluate the potential resale or releasing value, which means the lessor should consider how much the assets can be sold or leased again for a future. Our third point is profitability. Compare leasing income to the cost of owning and maintaining the assets, which means the lessor should check if the money earned from the leasing the assets is more than the cost of owing and taking care of it.